Hi, everybody, and welcome to another of our season two Meet the VC. I'm Paul Manivanan of Tech and Partners, and today we have Mahesh Narayanan. Did I say that right, Mahesh, first?
Close enough. Mahesh Narayanan. Yes.
Narayanan. My apologies. It was
Oh,
close enough, and I'm used to this as well because nobody can ever pronounce my name. So we're brothers in that respect.
absolutely.
Okay. It's great to have you on, Mahesh. I'm really looking forward to this episode. For those of you that don't know Mahesh, you're going to be able to search him. You're going to be able to find him once you're viewing this episode. And so I'm really looking forward to hearing more about those stories. But just as a very brief kind of overview, Mahesh is the managing partner of Neuvation Ventures, a Baltimore-based impact investment fund focused on brain health, and I'm sure he's going to tell us lots more about that. But also within Mahesh's wheelhouse is he's also the chief executive of Matchplay, a syndicate of funds focused on investments and the due diligence process around that. And I'm sure that you're going to have lots of opportunities to tell us about that as well, Mahesh. So, firstly, welcome to the show. It's great to have you.
Oh, thanks so much for having me. Absolutely. Happy to be here.
Amazing, amazing. And you're currently in Baltimore, right? You're in Baltimore now?
Just got back to Baltimore from Bio in Boston.
Ah, amazing. Yeah, of course, of course. Okay, so let's get to it. Okay. Um, Today is all about kind of learning a little bit more about you, a little bit more about what about the amazing things that you're up to, how you got into this journey, because all of our founders and founder network, they're kind of really interested to know, okay, what makes these guys tick and how can we, how can we properly engage with you and understand you. So I'm really looking forward to this conversation. Um, in terms then of your journey so far, can you share a personal story or experience that has had significant impact on your career as a VC?
Yeah, absolutely. I think you know, just to kind of start off, I come from an academic background, so I did
Ah,
my graduate work at Penn in neurology. I was in big pharma for many years, kind of doing R&D there, and kind of randomly had the entrepreneurial bug kind of bite me, and while I was there, and working on a couple ideas, which again, given big pharma and not to their own fault, but they're quite slow and quite bureaucratic, and the innovation doesn't really take place as fast. And so, we kind of moved from trying to do everything within the big pharma space to let's
yeah,
start with smaller companies. Let's see what we can do there. So we initially started a diagnostic company, which we successfully exited out into a big pharma company, and then came out to be part of another cell and gene therapy company, and that too was over the years been licensed and spun out in multiple different ways. But what really kind of changed the trajectory is even though I've been actively investing as an angel since 2016, since my first exit, what really changed my career was pretty much the diagnosis of autism within my family. At that point, this was 2020, just as the pandemic was starting to hit, and one of my niece was diagnosed, and the whole kind of family turned around and said, "You're the neuro guy. Figure this out." And I hadn't been in the
mm,
space for almost a decade, so I thought maybe there is something that's already there that I don't have to be necessarily the one trying to help her single-handedly, but to my sadness, nothing really had changed. There was really
yeah,
more disappointment, really, that more options weren't available for her. And given the particular severity of her diagnosis, she was very much in the lower end of the spectrum. She was nonverbal, very low IQ,
all right,
low motor
wow,
skills. And so when she was diagnosed, the pediatrician who diagnosed her pretty much said, "Look, someone has to take care of her for the next her entire life for 24/7, and if she's not going to be able to really act independently," which was again quite disappointing for us to hear. But throwing the pandemic in there and not being able to actually meet speech therapists, not being able
yes,
to talk to ABA clinicians, and also to further disappointment, knowing that there's a 2-year wait for ABA clinicians to begin with, it
yeah,
all started to snowball to the point where we're like, okay, like we're quite helpless here. What's going on? And so that's when I started to reach out to my academic contacts from my previous academic life, as well as my startup contacts that I've built over the years, to figure out what's actually in this space. What are people working on that we can potentially use for her in a virtual environment, because it's the only thing that we could use at that time.
Yeah.
And we had about almost 60, 70 researchers from around the world reach out and say, hey, we are working on something that could potentially help. Do you want to try it? And so I ended up ordering a Meta Quest and kind of reprogramming it to work with all these different technologies that were out there.
Wow.
We connected it to robotics. We connected it to virtual environments. We connected it to augmented reality. So there was just so many things we were trying, and luckily there were a couple of things that worked really well for her. Her speech improved dramatically. Within 2 months, she said her first word, which we did not expect. Within 12 months from then, she started speaking in full sentences. And now, again, pretty much 5 years in, like any other 11-year-old, we can't shut her up.
Wow.
We've seen
Oh,
so
that's
much progress
amazing.
there. But even that first 2 months, I was like, wow, this is amazing. Like, why aren't these technologies available to everyone? And when
Yeah.
I went back, the common response from most of them were, well, we're academics. We don't build companies. We don't build products. We have ideas. We research, and that's all we do. And then
Yeah.
the other part of the equation was that we don't have funding. No one's out there funding these type of early stage technologies in the neuro space. And that's really what sparked my
Yes.
interest in looking at being an active investor in the space, because I realized all these ideas were there in
Yeah.
academic centers and 1 or 2 person teams, but no one was really willing to back them. And so initially, I was looking to help with other funds like Autism Impact Fund, but then I realized the best way I could get involved myself and really push a lot of these early stage ideas was be able to create my own fund that really looked at all aspects of brain health, and really seeing which parts can help the autistic community. That's certainly the
Yeah.
neurodivergent community is close to my heart. But I realized that there were so many technologies that are applicable across brain health that we could really use anywhere. And so that's kind of the thesis and really the culmination of everything that came together through Neuvation Ventures.
Wow. Wow, wow. And I think it's one of the most powerful ways to begin any type of business, enterprise, any type of mission, when it's driven from something that's really personal, and we find this so much with founders as well, where they've got this personal, this button. I know we had a call with a company just last week, and obviously the story with those guys, where there's that personal kind of breaker and something in the family that then changes the whole course of the journey. And I think that it's very obvious that that's something that's happened to you as well. And I think that's really heartwarming. It's great for founders to hear as well, because it's like, you're going through this stuff as well, and the reason why you're doing it is because there. And I thank you for that. And it's quite clear as well that that's a strong motivator then for you to go into venture capital, and help to kind of fund these companies, because that's a huge challenge for them. How do you approach building relationships with founders, and what qualities do you look for with potential investments?
Yeah, I mean, I think this is common with most VCs, but we like to build relationships over a period of time. That is not once have I ever met the founder and then written a check the next day. Just doesn't happen. Even when I was an angel investor, the very early stage, there might be some that kind of just go with instinct and just really like the founder, really like the
Yeah.
mission, and they kind of are able to write a smaller check. But as VCs, one of the things that founders have to understand is that it is not my money. I'm managing this money for other larger limited partners, and so it is their money as well. And I have to be a good steward in making sure that I invest in a good
Absolutely.
company, because as much as inherently healthcare is an impactful space, and anything we do in healthcare is going to either save lives or touch lives in some way that's going to make it better for them. But at the end of the day, a VC game is still the money game, and then the founders game is
Of
also the money
course.
game, right? And so,
Yeah.
at the end of the day, if there's no money involved where everyone's going to benefit, that's something that also makes it harder for us. And so, we have to build that relationship over time. We have to build trust over time, and oftentimes it takes
Yeah.
anywhere between 6 to 12 months before we even decide, what, let's look into diligence with this company. And so, I think my earliest, the first company I invested in, I mean, we knew the company for almost 2 years before we made the first investment, from the fund.
Yeah.
That's just, how things are built. And, oftentimes founders
Yeah.
get disappointed. I've been a founder, I've been disappointed where I'm speaking to an
Yeah.
investor and then, that's a really good conversation, really good connection, but then, no response, no investment. It's like, hey, look, I thought I had a great
Yeah.
connection. What's going on? But now sitting on this side of the table, I'm realizing, oh, it's not just about a single point to make that decision. It's really about creating multiple points, creating a multiple trajectory. When I have a conversation with the founder, one of the first things I like to hear are things that they're going to be working on in the next 2 to 3 months. Because
Yeah.
what is a good measure for me is in 2 to 3 months, I'm going to go back to the founder and say, hey, what did you end up doing? Did you do what you told me that you were going to do 2 months ago? And if
Yeah.
the answer is yes, great. Now, I have 2 points to say, hey, this person can execute, right? And then
Yeah.
I'll do that again another 2 months and say, okay, so what else are you going to work on? I want to come back and check
Yeah.
you out 2 to 3 months. And so it slowly builds up those points where when things are moving the right direction,
Yeah.
I start to take notice and start to make an investment. When things aren't going the right direction, then it becomes harder for me to say, you know what, this is a check that's worth writing because
Do,
it's all
do,
about execution.
do you know, this is like literally like music to my ears because this is something, and it's so great that it's coming out of your mouth and not mine on this occasion, Mahesh. But it's something that I hear so often from investors, right? So as you know, we work with lots and lots of founders who are all looking to raise capital, right? And quite often we'll start to work with them, and as part of what we do, we're going to introduce them to great guys like you with heuristic, innovative funds that want to help people. And in the midst of what I mean, these are great founders, these are great human beings, people who care deeply. But in that moment, they're thinking, of course, about the money because they need some capital to move forwards, and
Right.
they see. So they see, and I think this is one of the big challenges: is that the founders see the investors in a transactional way also, like they see you as a transaction, and what they don't realize and what we're constantly trying to say is, like, you're dealing with human beings. This is a
Right.
buying decision. I say this all the time. People constantly mock me for this and laugh at me for it, right? My friends do as well, my colleagues. But I say, like, if you're buying a pair of sneakers, right, or you're buying a pair of jeans, the process is the same, right, as
Right.
investing. Like, hear me out, right? You want to see it, you want to feel it, you want to be able to go down a little rabbit hole and feel it a little bit more, and you want to understand it. You might want to know where was the denim sourced, right? What was the provenance behind the sneakers, right? All of these things. And it's the same. And what I say to founders all the time is it's the same with investors, right? You've got to see this as like, as a relationship, as something that, like, that they're going to invest in terms of this. And so, quite often we have conversations whereby, the founders are saying, why haven't we got a meeting yet? Why have we not spoken to them yet? And I'm like, because that because they're doing their due diligence in the back. Well, what are they reviewing? Maybe they're looking at some of your social media, and they're looking at some of this, and but they're trying to warm to it, because every decision that involves a human, I don't know what your thoughts on this, there's an element of emotion. There's like a feeling, like, is this the right thing to do? And human beings are searching for that trigger point where they say it's the right thing to do. Um, and of course, different human beings are different, and they see things differently. But that's something that we're constantly saying. So to hear it from you, where you're saying, I want to speak to them, then I want to speak to them again in 2 months, and I want to speak to them again, and I want to understand, and then, further in this line, I'm going to go, yes, I want to give you the money. Is great.
No, and again, you brought up a great term, which is the relationship between the founder and the investor very much is like a marriage, right? Like you have to go
Yeah.
through the dating process. You have to get to know each other. Like no one's going to just write you their first check after the first date, right? Just like no one's going to
No.
expect you to get married after the first date, right? And
Yeah.
and the joke, there's a joke within VCs that the relationship between founders and VCs traditionally last longer than most marriages. And so we are in it
Yeah.
for the long game. We are there with
Yeah.
the founder until the exit, whenever that might
Yeah.
be. Whether
Yeah.
they're getting acquired, they whether go to IPO or they shut down. That's a more often than not, that it ends up being the outcome, and we are open to that. But
Yeah.
we still want to know that there is an exit out there, that we feel confident that what, you and I can go together till the end. We see the light at the end, and we're going to be able to
Yeah.
walk towards it, hand in hand. And that's going to take some time. It doesn't happen overnight.
Yeah, absolutely. Can you share an example of a startup that you've invested in, and how you've supported their growth beyond just that financial backing? And that's a great segue to the marriage piece, right? Because it's much more than just finance, isn't it? Than just money. So
Absolutely.
give us some example. Give us an example.
Yeah, absolutely. I mean, again, for us, when we invest in a company, there are there are many different types of VCs. We are, an early stage VC that's very hands on. There are many other early stage VCs that kind of just hand the money, and they give you the resources, but only if you ask. We really don't, fall into that category. We very much give you the resources whether you like it or not, because we know what you need, and more often than not, most founders don't know what they don't know, and oftentimes it's our job to kind of teach them, hey, at this point you're going to need these individuals to help, and we have those contacts that are available here. And so for us, very much the money is oftentimes the smallest part of the equation. We try to bring value well beyond whatever the $100,000, $200,000 check we can write. Our hope is that outside of the $100,000 check, they're bringing in another $1 million worth of value, that either when it comes to advisories, or when it comes to putting in front of the right customers. Because once we put the money in, we're all in the same boat, right? I want you to succeed, because that ends up being my success. And so at no point do we want to see each other as enemies in any way. We're very much all in the same boat. So if the founder fails, we fail, and that's definitely not why we're investing. And so we're going to do everything we can to make sure the founder gets the right resources. And so one of the first companies we invested in, there were issues with the two founders kind of coming together, and eventually one of the founders did have to leave, and unfortunately the first founder, he didn't know how to manage that. We came in to kind of manage that situation for them, and said, hey, this is how, if there's going to break up here, let's break it up now before we put the money in. And so this was a conversation that we took place even before we actually invested. We actually helped them facilitate that conversation to say, look, the best case scenario, let's figure this out. We were able to successfully remove that founder from the company, and he was happy with what he received. The current founder was happy with what they received, and then we were able to come in more confidently, saying, you know what, we have someone that's willing to stick it to the end, because the other one was not willing to do that. And so those type of conversations we've had. We've had other issues where we put them in front of the right customers. They had they went from 0 customers when they first met us to moving towards $500,000 in revenue within 6 months, because initially they were talking to the wrong people. They were just talking to the wrong people in the organization. And then we were able to say, hey, have you spoken to the CIO? Like, he is a person that you should be talking to. Have you spoken to them? Or here's the CEO of this company. She's the person that you should be talking to. Why are you talking to this low-level director that has no say in are you going to buy this product or not? That's just not the decision they're going to make. So us being able to put them in front of the right people elevated their sales process, because then they realized, okay, this is actually a customer profile. It's our C-level suite, not the senior managers. And so there are many different ways we try to help them. But one thing we see ourselves as is caddies. We don't play the game for you, and we tell that to every founder. Look, I'm not here to fundraise for you. I'm not here to run your company. I'm not here to build your sales pipeline. I'm here to give you all the resources that you need to execute on it, because we have 40 companies that we have to manage. I can't run all the companies all the time. So we have all the resources. We are happy to help you as much as possible. But we have companies we're investing in, we have companies we're doing due diligence on, we have companies that have already invested in, and so there's only so much we can do. And so we're not there to run a company. We've had CEOs ask that, hey, can you just help me, get this deal done? Like, no, like you're the CEO. It's your job to get the deal done, but I'm here to help you in every other way possible. And if you want to, use me as an idea board, great. If you want to use me as a way to, sell as a mock sale, great. But I'm not sitting in that sales call with you to convince your customer to buy this product. Like, that's your job. I'm here just to help and be the caddy, but then tell you, what you can do, but how you do it is up to you.
Yeah, yeah, yeah. And in terms then of like, if there was one thing that really sets you guys apart, I mean, you've talked about some of the things that you do, from other firms, for example. What would you say that was? What would you say the one thing is that kind of sets you apart that's different?
Yeah, so I think this kind of goes to something else you had mentioned, which is something else a co-founder, which is Matchplay. Matchplay is very much a unique platform, and the way that we work is quite unique from most VCs because it's a syndicate of funds. So it's not just one fund; it's multiple funds coming together with a common theme or idea on what they invest into. So each fund acts independently from the investment side of things. But what we've brought to the table is that we've brought a centralized platform for deal flow and diligence. And what this allows is that we're able to provide this diligence for multiple funds at the same time. And so when we come in as an investor, we try to bring in not just one fund, but multiple funds coming in to syndicate that deal much, much faster because you're not having to go through diligence with each investor individually. All
Yeah,
of them have already seen the diligence because we've all been part of that diligence from the beginning. So when we say, hey, I want to put in a $100,000 check, oftentimes the 3 or 4 of the investors saying, you know what, you're going to match that. So rounds go much, much faster because you're not spending time fundraising for a long time. You're kind
yeah,
of going through that process much, much faster. But within Matchplay, the other value that we provide is that all the diligence that's done on a company, and it's actively being done. We don't just stop diligence. And this is something else a lot of founders don't understand. When an investor invests, we don't just stop our diligence. Diligence continues constantly because we're always adding notes to that diligence. We're changing things around to figure out as you progress, how does the company grow? Because that diligence becomes part of our next round of investment. And so we
yeah,
don't sit there and go back to diligence again. That diligence continues throughout the time. But one of the things that we offer to our founders is an active look at that diligence at all time. So once the diligence is done, unlike most VCs, we provide the full diligence to them, the good, bad, and the ugly. They get to see what we saw in the company, whether we invest in the company or more likely why we did not invest in the company. And this
yeah,
often helps them fix what they need to be fixing because
yeah,
the goal of diligence is to figure out how many holes there are in that boat and then to figure out how big or small those holes are. But that's all we do in that diligence. If you're trying to figure out how many holes can we poke, but it gives the opportunity for the founder to figure out, oh wow, I didn't realize I was a hole here. Like this is not something that
yeah,
has ever come up in a conversation with investors because they oftentimes don't want to disappoint and they don't want to necessarily be the quote unquote bad guy. And
yeah,
one of the things that we decided
yeah.
a long
No,
time
no,
ago is
I
I'd
think,
rather be the bad guy now because I'm going to be the good guy when I actually invest in a company that's going to make everyone happy. The founders are going to be happy. The patients are going to be happy. Our investors are going to be happy. I'd rather be the bad guy now and tell them what's wrong because that helps them fix the company versus just going around with blinders on and constantly asking money from companies or from investors. But then all the investors are seeing what's wrong except the founder. And so that's really what the diligence process allows us to do is to
yeah,
tell the founder, hey, these are all the things that are going to be wrong with your company or what we identify as being wrong with your company. And if you fix this, and this, there's a potential that we can invest. And this
yeah,
allows the founder to go back, fix what they need to fix. But we do that even after investment. We continue doing diligence and saying, hey, we found a couple more holes here that you need to plug before we go to the next round of investment because
yeah,
other investors are going to find the same thing. And this is an issue for me as well as for future investors. So let's
yeah.
help you, plug these holes before we go raise the next round as well. So we kind of play, that game quite well with founders.
Yeah, and I think that kind of segues really nicely into kind of the next thing that I wanted to ask you about, which was like, what would you say are some of the biggest challenges that startups face when raising capital, and how do you help them to navigate that?
I think it's telling the story. Uh,
Yeah,
Most of the founders, especially in life sciences, have a very strong technical background. I came from that background. I understand the problems that we had when we first started raising capital for my first company is because we just sometimes it becomes very hard for someone that's so dwelled into that science for 20 years for us to come
yeah,
back and try to present it to a layman. It just becomes impossible because
yeah,
what we think is lay oftentimes becomes a whole PhD for someone else. And so
yeah,
to be able to dumb that science down to many investors and have them understand what is the key value, what is the key proposition that we're trying to address with this
Yeah.
particular technology, and how is it going to change the lives of the patients? How is it going to change the lives of the doctors or providers that they use that particular technology? And then how will that in the end benefit everyone else that's been part of the company? How
Yeah.
is it benefiting the founders? How is it benefiting the investors? What is the end game for all of us here? Is it just going to go
Yeah.
on forever, or is there going to be an exit somewhere down the line? And so being able to kind of shrink that story into like a 2 minute story that's going to have a nice hook where I get interested, and then but also you tell me, why does it matter, and then how is everyone going to benefit, right? And that
Yeah.
that why and how is what most founders forget. They tell us the what really really well. They're like, this is what we do, and this is what's going to happen, but it's like, okay, why is that happening, and how do you make this happen? Why is this different, and how is it different from this other person doing the exact same thing, right? And that's
Yeah.
usually where the stories fall apart, because everyone focuses on the what, and very often they don't forget, they completely forget the how, and most importantly the why, for
Yeah.
why this technology is supposed to exist. That's something that we have trouble with most healthcare companies.
Yeah. It's a really interesting one because I think that actually that is a challenge across several markets. So you're talking
Oh,
about
absolutely.
sort of, within your markets, but I think like I mean, we work with companies in Web3 and deep tech and all of this stuff, and lots of the time we have conversations, and you speak to these incredibly intelligent founders, and they literally may as well be speaking another language, and the number of times we talk about kind of really distilling that message and bringing it into something that's like that a child could understand, and the importance of that. And it's a real challenge because, like you say, when you spent your whole life in academia, or in deep tech or in science, for you to perhaps the most simple version that you've got in your head is would be the most challenging version to most of us in this world. And so what how I tend to say it is, because in the past I have actually had founders, we've had founders who've almost like refused, who've said no, we're just going to go down this line, and if the investor doesn't understand, they're not the right investor. And what I've said to them is, okay, let's reframe this. If this was your prime customer
Hmm.
and they needed it to be packaged in order for you to sell it, like, think of it in that way, right? You wouldn't, if you were, to your customer base, you wouldn't missell to your customer base
Right.
just because your ego was telling you that this was the way to do it. You wouldn't do that. You would certainly reword it, and you would find a way to package that so that the customer could get it. And I'm like, you have to do that for the investors as well. Not because the investor is like, is incapable of understanding, but that it isn't their job to understand. It's their job to work out whether or not this is an investment, right? So, and these are the challenges that there's always going to be.
Right, and this is something that my team has a problem with me all the time, because I love the science, and I kind of have this joke that I'm dangerous enough to point holes in every potential science. I'm just not dangerous enough to know how to solve it. So
Yeah,
which makes me a really good investor, because I try to find the problem very very quickly, even if it's not something within neuro. I'm able to kind of understand and say, I know enough of the science to say, what, that doesn't make sense to me. But that's usually where the founder is supposed to tell me, okay, hey, great, you're absolutely right. This is how we solve it. So it's great that you know
yeah,
that there's a problem here. This is how we solve it. But my team kind of gets annoyed with me, because I kind of start diving straight into the science very very quickly, and they are not the ones
yeah.
with the PhD. So they're coming in with the CPAs or
No,
MBAs, and they're like, "What are you two talking about? That's not even English anymore. What are you guys saying?" And that's
yeah,
often the
I know.
crowd that's writing those checks, and that's where founders kind of go awry, is that they need to realize that most of the investment committee, for better or for worse, doesn't have a scientific background or a fintech
No,
background or a clean tech background. They have an MBA. They might have they have a business background. They have a corporate
Yeah.
background, and
Yeah.
that's they have a consulting background,
Yeah.
and so they all are good at. And again, they're dangerous enough to know what they're doing, but not dangerous enough to figure out if something makes sense or not. And so if you don't dumb it down
Yeah.
for those, the lowest common factor, as we say, then you're going to miss with all the investors because that always
Yeah.
needs one
Exactly.
person to say no in the committee, and it's going to be a no because it's almost always all of our investments are unanimous votes, and if one person says no, that investment's not happening. And so they always
Yeah.
say, hey, get one investor to say yes, but oftentimes that's not how it works. You want everyone in the room to say yes, and that means getting the person that's not the investor to say yes is the hardest task in an investment
Yeah.
committee. So you
Yeah, well,
got to get all.
that's actually a really interesting point because what you're basically saying there is, for every investment, there's like a committee, and I guess
Absolutely.
so what you're saying is to the founder has to be able to entice the lowest technical knowledge person on that board, because if that person on the committee doesn't get it and the other nine do, then it's still not going
It's
to
still a
happen.
no. It's still a no, exactly. And then that's why it's so
Yeah.
hard for investors to make investments. Oftentimes, founders will come and say, "Hey, I thought we were a perfect fit for you. What happened?" It's like, well, it was a perfect fit for me as an investor, but I have four other people that said no because they did not understand it. And it's again, it's not my job to convince them to understand it. It's your job, and unfortunately, you didn't do a great job doing that. And so that's another type of information that we provide our founders. Like, you can't just get one yes from me. You got to get my entire team to say yes, and unfortunately that wasn't the case.
Yeah. Yeah. And in terms then of that knowledge base, I mean, you've obviously said that I mean, we know that you're from a scientific background, but how do you stay informed of emerging trends within the industry, in order to identify the most promising opportunities?
And again, I kind of leave that to our founders. They teach me something new every day, and part of being an academic, I insist that they send me publications on anything that they're doing, and kind of giving me the information that I need to make that decision. And oftentimes I rely on them to provide me with the expertise that I should have in order to make that decision happen. So for me, it's a learning experience every day for me to meet new founders, see what they're doing, learn more about what they're doing, what the industry is looking like. And I by no means, I'll be the first one to admit that I do not know everything about everything. That's just, and I don't think any investor will ever claim that. And if they do, they're certainly lying, because it's just impossible to know everything about a particular industry, let alone one niche in an
Yeah.
industry. So I very much, I'm constantly learning from publications. I'm constantly learning from our patent reviews. That's another place we go to often that founders don't realize. But if I know there's a patent available, I'm going to find it and I'm going to read it. And I'm going to figure out what makes you different. And if your patent looks the same as every other patent that I've seen in that space, I'm sorry, it just doesn't stand out in a way that makes it interesting for us. So there are
Yeah.
multiple things that we review, but oftentimes the patents and the publications is where we try to find emerging trends, and we start seeing multiple publications on a particular topic or a particular target.
Yeah.
We get more interested because more and more companies are coming with those ideas, and we
Yeah.
make sure to know that that's something that's going to come up. So we have an entire team that just reviews patents and emerging trends just based on publications.
Crazy. Amazing. Amazing. Um, can you share a specific investment decision that you made that didn't go as planned? Obviously, you can't name them. We understand that. But that didn't go as planned, and what you learned from that experience.
Well, again, I think most investors would agree. We missed out on many, many great deals, and there are many, many deals that we thought were great, just happen to not be great. And again, we're playing in the law of numbers here. So by no means will we say that every investment we make was the best investment that happened. More likely than not, that's not the case. Just because there are more companies that shut down than there are companies that make billions of dollars, and so it's just the law of numbers. There are many that most investors have more misses and more losses than they like to admit. But I think one of the companies that we invested in that didn't turn out as planned, not really to any fault of the company or the founder, is just that the founder was unfortunately diagnosed with a debilitating disease that enabled them to continue as the CEO. And most of the the biggest reason we decided to invest in the company was for the CEO. And so when the CEO was no longer there, the team just could not muster the resources and expertise needed to move the company forward. And that ended up being one of our losses. And the other side of it is we've also had companies that just did not execute. We thought that was a team to execute, but unfortunately, they took too long to do what they needed to do. They ran out of money. They tried to scramble and try to raise money at the last minute. They couldn't, and thus, the company had to close. And when it's very hard for investors to come in and write a check when you tell me that you only have 3 months left, because that to me means you didn't plan your raise properly, which now you're putting my existing money in potential at risk, but then you're asking for more money to potentially put more of it at risk, because I'm not sure you're going to be able to raise the money that you need in 3 months. I mean, this particular market, in this particular environment, if you tell me that you have 3 months left, there's just no investors that's going to take that chance, because there are many deals where they're coming to me with 18 months runway, right? And it
Yeah.
might not be the best technology I've seen, but that company has more chances to succeed just because they have a better runway and more likely to raise what they need to raise to pivot and get to where they need to get to, versus a company that only has 3 months left. And so we have had teams that have mismanaged the funds and just didn't raise at the time they're supposed to raise, thought they would get to that one more milestone before the raise, and that one more milestone took them
Yeah.
6 months more than they thought, and now they had 3 months left, and unfortunately we couldn't support that company moving forward, and that had to in essence close at the end. So that would be another potential success, or sorry, potential loss there. But again, it's very hard to say what we learned from a lot of these, because each situation is unique. But certainly when it comes to fundraising, I think we've gotten much better at telling our founders when to raise and how quickly to pull that trigger. And we're not waiting for them to get to milestones. We pretty much say, look, this is
Yeah.
the milestone. Raise what you can right now, because you have 18 months. That's great. It might take you 12 months to get to where you need to get to. Wait for your your data at that point, but don't wait until you get to that data point, because then you're
Yeah.
going to have 12 months, and that becomes that much that much harder for investors to say yes for an investment. And so I think
This
one of the
this
big learnings, yeah.
this is like literally the biggest thorn in our side. So if you think about the work that we do, the number of clients that we engage with who've got 12 to 18 months, right? And we say to them, perfect. Like we can help you to accelerate this whole project. We can help with lots and lots of different ways around your data room and all those cool things. And we can help and we can mentor you through this process. And the number of them that say, well, I've got 12 to 18 months, and then they go quiet, and then they come back 15 months later
Right.
and say, hey, I've not raised yet. Um, can we do this now? Can we work together? Because I've got to get this money in 3 months, otherwise the business is over. And literally, I mean, it probably feels like if anybody's watching this or whoever is watching this, they're going to think that we've rehearsed this. We haven't. We 100% haven't. We haven't had this conversation. This is not something like the number of people I speak to are going to be saying, oh my gosh, Paul has definitely spoken to Mahesh about this. We haven't. We genuinely 100% have not spoken about this. But these are the conversation that we have all the time.
Right.
And it's so good to hear it coming from you to say that the investor, when the investor hears that and hears you say, I've got 3 months to get the money in, that is an immediate red flag to them. It's an immediate red flag, or it's certainly an orange flag, to the process. It's so true. Um, what advice would you give to early stage founders that are looking to raise capital for the first time? And you've given some already, right? So give us some more, because these are great pearls of wisdom. You've talked about time, you've talked about kind of the focus on building relationships and all of those things. But what else could you say to early stage founders, particularly those ones raising sort of early? Because you're giving 100K checks. You speak to lots of early companies.
Absolutely.
Like what do the good ones do, and what do the not so good ones do?
So when it comes to first time founders, and this is again always a discussion with investors. Do we want to invest in first-time founders, or do we want to go after more experienced founders? All right, but the problem is that there are only so many successful, experienced founders, because most of them first-time founders don't succeed, and they do very common mistakes that we see over and over. And one of it is, I think, not preparing themselves for an entrepreneurial journey. They need to be able to. I've seen too many people who just have lost a job, and then they say, you know what, I'm going to start a business. Perfectly fine. But business is one thing. But if you going to start a startup, and you're going to come to me and say, hey, I'm putting everything I have in this, then let me go for it. More often than not, they don't have enough of a coffer to say, I'm not going to, I won't be able to put, I won't have enough trouble to put food on the table for the next 3 years, because you're most likely not going to get paid for the next 3 years, right? They don't have the ability or the conviction to say, you know what, all my savings that I have, I'm going to set aside for what I need for the next 3 years. I'm going to put everything else into this, right? And that's conviction that they have. Often they want to come to me and ask me for the first check, and they've not put a single dollar into the company. That's not a company that I can back, because if you don't believe in it, how do you expect me, that I don't know you for that long, how do you expect me to give you $100,000 check if you aren't willing to put $100,000 into your own company, right?
Yeah.
And so oftentimes we like to see that conviction from founders, and what that really means is, it's not resilience as much as, are you putting everything behind this? Because that's the type of founder that's going to succeed. That's the type of founder that we want to back. Because if you lose this, right, you lose everything. Because that's the type of situation an entrepreneurial journey often happens to. If this doesn't work out, you lose everything, which means every inch of your body is moving towards, I need to succeed, right? And we're not telling founders, hey, like, lose everything, that's how it's supposed to be. But that's the type of conviction that we want to see from founders especially first-time founders, when we talk to them, is like, if you can't make this work, you're going to be set back for quite a bit, right? And that's the risk that you need to be willing to take, because that's the risk that I am going to take, right? And so, because this is $100,000 that we're willing to lose. That money is not going to come back, and we don't expect it to come back. But that's $100,000 I need you as a founder to also be willing to lose. So if you're not willing to lose that, then don't come to me and ask for money, because I'm not willing to lose that either, because I don't see that conviction from your. And so to me, if you haven't put money in your company as a first-time founder, it's an automatic no from my end. That's just how it is, because it's about, do you believe in yourself? And if you can't believe in yourself, then don't ask. And we don't count that as family and friends. Let me change that as well. Putting family and friends' money at risk is a completely different story than putting your own money at risk, right? They're both, it's close, but it's not the same as putting your own money at risk. And so don't tell me, oh, I put $100,000 from my dad. Great, but that's still someone else's money. Where is the money that what's going to make you worry about and keep you up at night if you lose this money? That's what I want to see, right? And because that's what I'm doing. I'm worried about, if I lose this $100,000, what am I going to tell my LPs, right? And so if I'm going to be put in that position, I expect others to be kind of put in that position as a founder as well. And so be willing to take that risk. And if you can't, then don't expect investors to take that risk for you. It's just not something that we are willing to do. And again, having been in that position myself, I can tell you that that's something that investors truly valued. When I said, you know what, I put everything I had, everything I've saved up, I'm putting in this company. I'm young enough, I'm willing to take the risk. If I lose it, I can go back and make the money. That's not always the case for everyone, but that's the risk that the investors were willing to see from me. And that's what I expect to see from the founders as well.
Yeah, and I think that's thank you so much for your honesty there, because I think so many investors perhaps wouldn't be as honest and as straight as you are being there. But I think that is it's really fair. Like, and don't forget, the demographic of people that you invest in are literally first time, like they're founders with brand new businesses. 100K is a kickoff amount of cash, right? So it's absolutely right that you're honest about that, and that actually you're saying that, if I'm so what people should be thinking is, if I'm going out there for 50K or 100K of somebody else's money, I'm going to have to show them that I am literally, willing to like go to the end of the earth for this, because the risk is so much higher. And I often say, like in terms of the work that we do, You know, some of the smallest work that we do is in the hundreds of thousands. Some of the larger raises we're involved in is, you know, in the tens of millions. And I say every time that it's much harder to raise 200k than it is to raise 20 million, because at the 20 million point there's much more mitigation. You know, there's millions of dollars of revenue somewhere, and
Exactly.
there's well, you know, rehearsed teams and infrastructure and strategists and all of this stuff that helps the investors. And it's actually the job of those investors is in lots of respects is easier because the number's bigger, but the risk is lower, if that makes
Exactly.
sense.
Exactly.
Whereas the risk for you is insanely high. I mean, like you say, I mean, I think the last published stats was something in the 90s of percent of businesses fail within the first 5 years. And I would imagine 100% of the businesses you invest in are within the first 5 years, right? So,
Exactly, exactly, right. And you know, part of it also is that you know that risk is analyzed again by not just one person, but there's an entire team behind that as well. So it's not one person's decision when we say, hey, like we don't see that you know you've taken enough risk to move this forward.
yeah,
And even in the later stages, as you said, that's why the early stage diligence is so important, and that's why we take our jobs very seriously because so many investors are relying on our early stage diligence to make their investments in the future. So when that
yeah,
you know, first $1 million comes in, very often the investor is not going to ask for their first diligence. They're going to just assume, hey, someone put $1 million in, so it's already de-risked. You know, must be a good idea, and that's
yeah,
often not the case. Sometimes, I should say, oftentimes it's not the case. But you know, that's why we take our job seriously because when we do our diligence, it's very, very much a deep dive, and then we're willing to
yeah,
share that diligence back with the founder only because
yeah,
we know how important it is. Because if they don't get the fundamentals right now, it's going to you know it's going to snowball to the point where they're going to lose millions of dollars in the future with others, and that's going to turn a lot worse for them then than it is if they
yeah,
lose you know $100,000
yeah,
now. So we try to get
yeah.
that fundamentals right the first time around, so everyone else is relying on that early stage diligence to move things forward.
Amazing. How do you envision the future of venture capital evolving, and what implications do you think that will have on startups and the overall investment landscape?
I feel like every time there's a revolutionary technology that comes out, they pretty much say, "Oh, VCs don't have a job
The
anymore."
end. It's the end. It's the
Yeah, this is
end.
the end of VCs. You know, there'll be no VCs. I don't think it's going to happen. And the biggest reason is, and this is something that I feel a lot of founders discount too much. Being a VC and being in the venture capital space is very much a human relationship business. It is not a money business. It's about who do you know, how long have you known them, do you trust them, do you build that trust over time, and so AI is not going to be able to do that. Computers aren't going to be able to do that. It just cannot be that transactional. It could turn that transactional in the public market because a lot of public market is algorithmic. But when it comes to early stage VCs, it's very much you know instinct and it's very much you know going going a mile with an inch of data, right? And that's
Yeah.
what we have to do is figure out how far this line can go. Based on this, you know, 1 inch, you know, how straight is that line? Is it something we have to predict? Is it going to go in a curve eventually, or is it going to go a
Yeah.
straight line? And so we're working on very little data to go a very far distance.
Yeah.
And so, you know, from that perspective, I don't think an algorithm is going to be able to do that, or an
No.
AI is going to be able to do that. We're going to have people there.
Yeah, so something that has been said to me before, which this is the way I think, this is my opinion on it, is I think there will definitely be a blend. So this is my thought process. Certainly on the early stage, right? I agree. I think later down the line it could be almost algorithmic,
Right.
right? Later down the line. But I think at this early stage for you, you know, for you guys in your space, it's like you could use it in order to perhaps source the best deals. So almost like for you to get to a point where, okay, everything's ticking off in
Mm-hmm.
terms of, right, okay, the risk profile, the financial, everything's like ticking off for me here. And the AI is kind of like filtering down, because I guess one of the big challenges when it's people centered, and we get this as well, is then how much of the market are you actually seeing, and how many deals are like flying past you that you never see because you're not able to catch them as a human being. Whereas almost like from your point of view, if the AI could somehow find the top 5 deals that were aligned with you, and then you could then do your people piece and find the two in that five that where the founder is the most aligned, that's like the perfect moment, right? And I feel like that's probably what you've got.
No, absolutely. And the thing, from the top of the funnel perspective, I agree. That's just impossible for us to capture every deal that's in the market, especially in the early stage, because most of the companies are stealth, or most of the companies are geographic, and so we're not going to be able to capture the Australian companies or the
No,
UK companies.
exactly.
It's just too much for us to look at. And so from the top of the funnel, I agree that there might be ways to bring that together, and that's something we're also doing in Matchplay, is kind of bringing all that together. But there's always a human element to it. So
I agree.
as you said, it could be the risk analysis. It could be we do something within Matchplay, in essence, scoring them like a credit score to a company. We kind of give
Yeah,
them a ranking based on all the deals we've seen in the past, all the deals that that we've seen from other investors, which ones got funded, which ones didn't get funded, and we kind of rank them based on some of those algorithmic scores. And I think that initial, what we call soft diligence, could very well, be a big component of moving
yeah,
the right deals forward in
I
front of
agree.
investors, right? And I think that's again something that we pride ourselves in Matchplay, is that it's not that we say that we are the wrong investor. We tell you, hey, this is the right investor for you. Like we're not the investors for you to talk to. Here's the actual investor that's going to be interested in something like this because they like to invest in this particular
Yeah,
vertical and this particular technology. And so, kind of putting in front of the right investor is very important. And I think that soft diligence component, as you said, is going to be very key. But when it comes to an
yeah.
actual writing a check component, I don't think that an investment outside of a human is going to be able to make that judgment
No, I agree.
today. And the thing that's important, I feel like in this early stage, there's just not enough data to say what company is going to succeed and what company is going to fail. And
No,
a lot of it is, a gut feeling. And then this is something we speak to our founders all the time. Like it's sometimes at the end of the day, the tiebreaker is the gut feeling. It's like, do I
yeah,
feel like this founder is going to make it happen, or do I feel like this founder is not going to make it happen? And that's just not something
yeah,
that can be determined algorithmically, at least yet. So maybe eventually we'll
yeah,
find it, but right now it's just not where it should be. So as a tool, it's going to be great, but it's going to be a tool. It's not going to be the final decision maker. It's not going to be what all of us rely on. I think that it's still so nascent, and so many ideas are coming up with AI, and we're still trying to figure out how
yeah,
to best use it for our best judgment. And a lot of it just comes
yeah,
down to the initial judgment versus the last judgment, because I feel like that final decision really has to be human centered versus algorithmic. But as it gets to bigger checks, as you said later, less risk, more data. AI can do a lot, but when there's not enough data, it's not the best judgment in figuring out which line this
no,
transaction
I
is going to
agree.
look like. So that's going to be a human element there.
I agree. I agree. Wow. Thank you so much. It's been an amazing chat and so much insight there. I think that these conversations, when we started the podcast, it was all about trying to level up.
Sure.
Every single time we do this, and every time we speak to one of you guys in one of these arenas, we get so much information, and so many of our founders reach out to us and are kind of like, "Hey, Paul, I really liked that about this, and can you do the intro because I really want to speak to them about that." So, I think that, well, I just wanted to say a huge thank you for your time and providing us with some really valuable information today. Um,
Thank you
it's
very
been
much
an
for having me.
absolute pleasure.
Hopefully the insights are useful to the founders, but again, really, as I said, it's very much a casual conversation. So if I said anything wrong or offended anyone, I'm sorry. It's just,
No, you what
time,
you certainly shouldn't have offended anybody. No, but the thing is, Mahesh, we've got to tell the truth. The whole point of this is a
absolutely.
leveling up. It's a leveling up, and there's no point. Like, s- to be fair to you, you've been really honest, right? You've been really honest, and that is really refreshing. We get a lot of honest people on here. I think by nature, people that agree to come on are willing to kind of bare their souls a little bit on here, and I think that that's a cool thing. But I think that honesty is needed, because then when a founder, when they put that application in or that conversation, and they get that bland kind of not a fit not a fit thingy, you know, they can start to think, well, maybe it was because of this, or maybe it was because of that, and you know,
Right.
I think it's really important. But yeah, it's been a pleasure to have you on the show, and I look forward to speaking and working with you in the future. And wish you all the best, and yeah, have a great one.
Yeah, absolutely. Thanks so much, Paul. Really appreciate it, and thanks for putting all this together. I know it's a lot of effort and trying to get all
Yeah,
these resources to the founder. So by no means is this an easy task. So
yeah,
kudos to you and your team for putting all this together, and happy to be part of it, and happy to at least partake and also impart some of the tidbits that I've gained over the years to the founders. So hopefully it's helpful to them.
amazing. Thank you, Mahesh. Take
Thank
care.
you.